Gina, we'll start with you first here. What has stood out to you in the price action over the last couple of days? The historic moves in the 10-year yields, the drop in stocks. What's going on?
Well, I think the thing that really has struck me is that one of the reasons that you're not seeing a bottom under the market is that you're just not seeing really screaming buys, you know, with the distinct exception of energy. And I think that that's a whole story in and of itself, and a falling knife. Outside of that, you still are taking a lot of froth out of markets that were really, really toppy when this began. And so I think one of the reasons that you're not seeing a lot of support under the markets is that things are still not well priced, especially if you consider that some of this is going to be short-term pain and we should be able to recoup some of this growth later, but some of this is true lost growth. And I think, you know, the general view is that we'll probably see sort of slightly a lower trajectory once this is all over, but we don't know when this is going to be over. And that's what's really we're picking at the markets 1,000 points at a time.
Sure. And
coming back up hoping that this is over, and it's not yet.
So, Steven, I mean, Gina brings up an interesting point about the pricing or mispricing in the market right now. In your mind, are certain parts of the market more mispriced than others, even given the types of swings we've seen?
Well, look, in this initial shock, you've seen healthcare stocks and airlines fall together. You know, sort of high correlation, all of these things just show a jumble. But when you think about global airlines, they're down about 30%. And if this is a crisis for the airlines, if this is a true terrible shock for a number of months at minimum, you could easily see much more downside pricing there, much more fundamental weakness. But, you know, at the moment, again, when you see investors just pull out very, very quickly, you get a bit of a jumble. And, you know, look, I think that across the world, when we're going to take a look at the other side of this, we're going to be whipsawed in lots and lots of assets. Bonds, we're overweight by 5 percentage points in U.S. Treasuries, but we're obviously getting into, you know, ever richer territory. If you take a look at global fixed income, we came into this with U.S. yields at a premium to the rest of the world. But when we think about stock valuations, as Gina just noted, we needed a recovery in EPS. We needed a manufacturing and trade recovery to justify last year's strong gain, and that's been just shelved right now. But I do think that we can recoup from this after a more meaningful drop than this correction thus far.
So interesting point, Gina, that Steven brings up here, that the kind of leadership, the valuation arguments that are permeating through the markets right now. One of the things that I noticed over the course of the past couple of weeks is that when we have seen these sharp rallies to the upside, oftentimes they're not necessarily led by large mega cap technology. They're led by things like real estate and utilities and consumer staples. Is there anything more to be read into that defensive trade that when markets rally, those are the types of stocks people go towards?
Well, right now, I think the sort of real estate, that real estate really is supported by Fed action. It's supported by the shape of the yield curve and what's happening with mortgage rates. And so that is very much sort of a story about yields. You know, if you look at the market right now, I think is still very confused. But one of the things that we sort of are trying to evaluate is which sectors are sustaining losses that cannot be recovered and which sectors are simply sustaining losses that will become delayed purchases later so they can recover those purchases eventually. And so if you look at the likes of the travel industry, I think Steven makes a great point. You know, those are probably not going to get recovered. So, you know, trips that you don't take now because your company called off all travel, you're not going to necessarily recoup at the second half of the year. If you're taking a vacation and you've canceled your Hilton reservations, you're probably not going to, you know, do more of that later. However, there are segments of the economy where you will recoup some of that. In parts of the technology sector where you have kind of a longer secular cycle in play, some of that is probably going to be purchases that will be recouped later in the year. So you have to think about what can be recouped and what's a permanent loss.
All right, so Gina, I just want to call viewers' attention and listeners' attention out there right now to what's happening with the markets because the Dow is now implied down 716 points. So over the course of the last hour or so, we've seen an implied open for the Dow down about 290, 300. All the way down to down 725 at this stage right now. So we're just bringing that to everyone's attention. Now, Steven, we'll give you the last word here. Gina brings up an interesting point with regard to the things that cannot happen. I mean, travel and leisure, the inventory there is like fresh produce.
Right.
If it doesn't get sold, it's not going to get sold again.
But just remember, again, when we're thinking about the other side of this, if you're down 50% and you just restore the old level, you're up 100%. So people think you cannot rebound quicker. There are plenty of natural disasters, things that have happened that we could cite where people thought it was impossible to get to a stronger growth rate. But you do. And again, the psychology now is just accepting the size of this shock. And again, there's a lot of unknowns, right, that we just have to clearly see and price in that uncertainty first.